Where's it going?
It's still going to India.
If you look at the rupee price of silver, it's now over 300,000 rupees per kilogram. At the middle of the year, it was 100,000 kilograms. They're going to buy silver, and demographically, they're going to buy silver.
You can turn on MSNBC, and it seemed like after $100, the mainstream media started talking a little bit about silver.
The London Bullion Market Association members, it was the comment of the conference, physical is king. Whether it's London Bullion Market or the COMEX or Mumbai or China, everybody says we got to have higher inventories.
I mean, the squeeze has been remarkable. There's been a lot of talk about whether this is a true squeeze. I mean, you can tell by the price action something is going on. I mean,
when the silver price has gone up, people tend to buy more than they do sell.
Looking at the backwardation, too, in the markets, you start looking at Shanghai premiums compared to the COMEX, the Scottsdale Mint, Josh Farron, he was talking about the hidden hand governments or those sovereigns are buying through the banks. Is this just the beginning of the rip? A lot of people here worried, or at least wanting to take profits in this market, worried about that bubble talk.
It's certainly possible that you'll have that, but even if you have a correction.
Silver, in fact, just as we went to market on Friday as the markets closed, trading above $103, a 7% intraday move last Friday. That gold holding firm just at the doorstep of $5,000. And platinum, we should talk about because most aren't. That's rallied more than 5%, confirming that this is a broad-based industrial panic is taking place. Now, the economics in mining, manufacturing, and energy have fundamentally changed. To break this down, of course, this new paradigm, what it looks like, I'm joined by Phil Bakert. He ran the largest U.S. silver producer for 2 decades and also served as the chairman of the Silver Institute, still an executive member of that institute, as well as San Cristobal Mining. Phil, welcome back to Kitco.
Okay, thanks, Jeremy. Good to be here.
Just a few things to get into since we last chatted. Let's start with this. Let's give a little bit of context to the audience, because you and I were chatting before we came on to the air here, and a lot has changed in the 24 years you've been in the business. 24 years ago when you were in the business, the
25.
price, 25?
This is the 25th year.
25, so $44.10.
Yep, that was the price when I became president of Hecla Mining. Wow. Was $4.10, so $99 less than where it is today.
This isn't a precious metals rally. It's a signal that the cost structure of the real economy just snapped. As Phil Bakert lays out here, silver, gold, and platinum moving together with 5 to 7% single-day swings points to industrial stress, not speculative froth. Gold holding near $5,000 while silver gaps higher mirrors past inflationary regime shifts, not retail manias. In 2001, silver near $4 coincided with global overcapacity. Today, supply chains are tight and energy costs structurally higher. Mining margins, capital discipline, and replacement costs are now the story investors need to track. This isn't about price excitement. It's about input scarcity reshaping balance sheets. What Phil Bakert hints at next reframes silver not as a trade, but as a stress indicator for the entire industrial system.
Do you ever imagine, and I should point out to the audience, even at 410, the economics obviously made sense to go into the ground.
It was super tough to operate a silver mine then, and it's still tough to operate it. But no, it's a different world, and it's a different world because the demand for silver has changed fundamentally. Two things. One is industrial demand, and the second thing is investment demand that you just didn't have back in those days.
It starts to look as though, we're in this room, we've been talking to a lot of people, it almost feels as though the retail audience is starting to pay attention. I mean, you can turn on MSNBC, and it seemed like after $100, the mainstream media started talking a little bit about silver. We had you on the show back in December. I called you up kind of panicked because we needed some truth into the system. There's a lot of fear out there, a lot of what the heck is happening. Let's go back to that, because on that structure, I mean, we're now operating obviously in a triple-digit environment. And, back in December, you were talking about that inventory step function where buyers would be forced to come into the market and buy that physical. I mean, is that what's taking place now?
The real shift isn't price. It's who needs silver and why they can't avoid it anymore. Phil Bakert makes a critical distinction here. In the early 2000s, silver demand was mostly optional and cyclical. Today, it's structural, driven by electronics, energy, and financial hedging. When mainstream media only notices after $100, it's already late in the process, not early. Inventory-driven buying changes market behavior because demand becomes non-discretionary. Investors should recognize this mirrors past commodity supercycles, where scarcity, not sentiment, forced repricing. Fear rises when supply can't respond fast enough. What Phil Baker explains next reveals why inventories, not headlines, now control silver's direction.
Well, not only is that taking place, but people are making sure they have inventory. Yeah. So one of the things I probably said back then was the London Bullion Market Association members, they have a conference every year. Yeah. And I went to that conference, and what I was struck by was the comment, and it was the comment of the conference, physical is king. And so what that means is whether it's the London bullion market or the COMEX or Mumbai or China, everybody says we got to have higher inventories, and it's true around the world. And as a result, you can see what's happened to the silver.
Yeah, I mean, the squeeze has been remarkable. There's been a lot of talk about whether this is a true squeeze. I mean, you can tell by the price action something is going on. I mean, is this move past $100 kind of confirmation that physical disconnect has occurred?
Yeah, I think it is, and what's clear is while there's a squeeze, it's a squeeze that relates to having the right silver in the right place in the right form, and so there's plenty of silver to go around, but people have to be willing to give it up for it to go into that right form, and they've been reluctant to do that.
Yeah,
and in fact, people have been buying more silver to hoard it, which is no surprise.
This isn't a shortage. It's a failure of paper markets to deliver usable metal. As Phil Baker notes, physical is king wasn't marketing language. It was a warning from insiders watching inventories tighten globally. The silver exists, but it's locked in the wrong form, wrong location, or long-term hands unwilling to sell. That's why futures pricing broke above $100 while delivery stress quietly intensified. Similar mismatches preceded the 2008 commodity spike and the 2020 gold dislocations. Investors ignoring form, location, and custody risk are missing the real pressure point. What Phil Baker describes next exposes why hoarding behavior may matter more than mine supply.
When the silver price has gone up, people tend to buy more than they do sell.
Yeah. Now, that's an interesting point. I mean, well, last time we had you on the show, you brought in the India discussion about that supply and demand. I mean, people have been stepping in and buying it just on the retail side, let alone some of the institutions. Talk to me a little bit about that metal, that's actually left London and New York now. Are you seeing any evidence in this? I mean, where's it going?
It's still going to India.
It's still going.
Yeah. So if you look at the rupee price of silver, it's now over 300,000 rupees per kilogram. At the middle of the year, it was 100,000 kilograms. Yeah, it's just been amazing how consistent they've been buying throughout this whole piece. You do get to some point where there's probably a pullback. There's got to be a reset in the minds of people. Do I continue to buy at these levels? Will it come? And once it sort of settles out for a period of time at these levels, there'll be more buying because culturally they're going to buy silver, and demographically they're going to buy silver.
This is where Western price models break, because India doesn't trade silver like Wall Street does. Phil Baker highlights a critical stat. Silver tripled in rupee terms within months, yet demand didn't collapse. It accelerated. That tells you this isn't speculative churn. It's culturally embedded savings behavior meeting currency pressure. Unlike ETFs, Indian buyers don't sell into rallies. They accumulate through volatility. Historically, sustained Asian demand has set long-term price floors, not tops. For investors, this shifts downside risk assumptions materially. What Phil Baker points to next explains why any pullback may be shallower than most models predict.
It's interesting. I mean, when you think about it, I brought up in the intro that 7% change in price on one day. That's unusual price action in the silver market, to say the least. At these prices, are recycles? I mean, we got people coming to the market, they're giving up their silver as well?
Yeah, they certainly are, but there's only so much refining capacity. Yeah. So it's a slow process for that silver to get converted into the form that it needs to be in. Yeah. And it's going to take a while for the silver to go through the system. And during that period of time, you'll have, I think, continued strength in the silver risk. Could you have a pullback? Sure. Yeah. But generally speaking, silver's not going to go anywhere south of where it is in a major way for some time to come, so long as the gold price continues to be strong.
So the macro thesis is there. And I mean, I have to ask you, because at $103 silver, I mean, it becomes obviously a massive line item for manufacturers in terms of cost. In your view, I mean, how elastic is that industrial demand right now?
Look, they are very rapidly. It's been estimated about 23% of the manufacturers that make the solar panels are rapidly changing to copper from silver.
A sudden 7% one-day move isn't excitement. It's a signal that the plumbing of this market is under strain. As Phil Baker explains, recycled silver isn't instantly usable because refining bottlenecks slow the conversion into deliverable forms, which means price spikes reflect logistical friction, not speculation. That matters because even at 103 silver, supply can't quickly respond, while gold holding near $5,000 reinforces the macro floor. Manufacturers talking about substitution sound rational, but history shows material switches lag price moves by quarters, not weeks. Investors should read this as temporary demand elasticity masking deeper structural tightness, not a reason to assume prices normalize quickly. Next, Phil Baker explains why substitution headlines may be overstating how fast real demand actually falls.
So I think you'll see that before the end of the year or early next year. It's either that or they're telling the market they're going to do that in hopes of seeing the silver price go down. I don't know which is true, but over time, there's no doubt that they will reduce the amount of silver that they're using in all the applications. But having said that, you have the economic growth that's occurring around the world, and you have the AI boom and the need for the data centers. You know, the demand for silver, while industrially it might fall slightly, it's not going to fall dramatically, and over the long term, it's going to continue to increase.
Yeah, it's interesting. I mean, looking at that backwardation too in the markets, you start looking at Shanghai premiums compared to the COMEX. I mean, you're seeing a big disconnect there. I mean, this is kind of the first time. Talk a little bit about that.
Well, realize that there is the VAT differential between the two, and that explains most of that difference. So I don't think that's such a big deal.
Well, I mean, do you see the stockpiles on the geopolitical side? I mean, obviously silver now is a strategic mineral in the United States.
When producers publicly threaten substitution, it often says more about pricing pressure than actual engineering timelines. Phil Baker cuts through this by noting that even if silver intensity drops, AI-driven data centers and global growth keep total demand rising, a reality markets rarely price correctly. Backwardation and Shanghai premiums grab headlines, but VAT differences explain much of the spread, deflating the panic narrative. The real story is silver's reclassification as a strategic mineral, quietly shifting it from commodity logic to security logic. That shift matters for investors because strategic materials behave less predictably and reprice faster during stress cycles. What Phil Baker hints at next reframes silver less as an input and more as a geopolitical asset.
China stepping in to buy more physical. Is it just a massive race to holding as much as you can?
Well, I think so. I'm speaking to someone, and I can't confirm this, but they were saying that they were speaking to people in the administration that are looking at increasing the critical stockpile of silver, which you haven't seen that for decades. So yes, the demand for silver, putting it in inventory somewhere where you have access to it, whether it's the exchanges, whether it's manufacturers, whether it's governments, or just individuals, is on the rise.
Yeah, it's been interesting. I mean, we had a conversation with, I think he was with the Scottsdale Mint, Josh Fair, and he was talking about the hidden hand being that the governments or those sovereigns are buying through the banks. So, I mean, a lot of the JP Morgan, all these banks are looking at that price. They're actually picking up the metal. Do you think that sovereigns are picking up physical metal?
I don't know.
Yeah.
I would not be surprised, just given that its characterization as strategic, and particularly by the U.S.
Yeah. Okay, let's talk a little bit about mining. That is why we're here.
Quiet accumulation matters more than loud price moves, and this part points straight at that dynamic. Phil Baker highlights rising inventory hoarding across governments, manufacturers, and exchanges. Behavior we haven't seen since silver fell off strategic radars decades ago. When sovereigns potentially buy through banks, it blurs commercial versus state demand, making supply signals unreliable. For investors, this raises risk on both sides. Upside scarcity during stress and sudden liquidity drains are if policy shifts. Strategic stockpiling changes volatility profiles and weakens traditional valuation anchors. Next, Phil Baker connects this hidden demand to why mining supply can't simply ramp to meet it.
You know, we've seen some of the juniors have some great upside. A lot of the majors seeing that upside. Obviously, margins have increased here, but there's still costs involved. Your old employer, Hecla, 26% last week. Are stocks starting to see this? And is this just the beginning of the rip? A lot of people here worried, or at least wanting to take profits in this market, worried about that bubble talk.
Look, it's certainly possible that you'll have that, but even if you have a correction, can only go so far down. And I look at these silver producers, and what I recognize is there is a limit as to the growth that you can have in production. Remember, peak silver was in 2016. So a decade ago, we produced more silver than we have in any year since, and we will continue to see 2016 as the peak until at least 2030. There is not enough projects that can go into production in the next 4 or 5 years. It's just not going to happen.
So is there quality? Again, I ask this because I know you're in the market. Actively looking at these as investments. You know the market well.
Mining stocks aren't rising on enthusiasm. They're reacting to a hard ceiling on supply growth. Phil Baker reminds us that global silver production peaked in 2016 and won't be surpassed until at least 2030, regardless of price incentives. That means margin expansion doesn't translate into rapid volume growth, a critical distinction markets often miss. Corrections can happen, but structural scarcity limits downside in quality producers with stable jurisdictions and cost control. For investors, this shifts the focus from timing tops to owning durable operators through volatility. What Phil Baker explains next sharpens the difference between speculative juniors and miners built to survive this cycle.
Been in it over 25 years, Phil. Tell me about the ideal investment in the silver mining sector right now.
Look, I think it's a mixture of things. The producers, those guys have the ability to continue to grow their reserve base and do incremental increases in production. Step function increases, really hard for anyone to do. And then you've got some very specific development companies, but they're still 2 or 3 years away. And in terms of the total market, remember the miners produce about 900 million ounces of silver. Nobody's going to be a 9 million ounce, 10% of that market in the course of the next 5 years. So I think that's the place to be with those producers and to be with those development companies. And now you're finally starting to have exploration that's occurring.
Right.
And so there's an opportunity there as well.
Even if the new capital floods in like it has been, how long for new ounces? It's not tomorrow.
No, it's at least 5 years. And that's with projects that are already in the pipeline. So just rest assured that you're not going to see very much from producer, and you're not going to see a lot from recycling.
The overlooked truth here is that capital can move instantly, but new silver supply moves at a glacial pace. As Phil Baker explains, producers can only deliver incremental gains, while development projects remain 2 to 3 years away, even under ideal conditions. With global mine output around 900 million ounces, expecting a single company to add meaningful market share within 5 years ignores basic industry math. This reshapes investor risk. Price volatility comes fast, but supply relief doesn't. That imbalance favors disciplined exposure to producers, with reserves already in place, rather than chasing future promises. Next, Phil Baker clarifies why even aggressive investment won't change the supply picture quickly.
Because there's just not a lot of capacity, and that again will take 2 or 3 years, and that's only 150 to 200 million ounces of silver coming from those sources. So nothing, it's a 1.2 billion ounce market. And if you think about it, at $100, that's $100 billion market. That's still tiny, tiny, tiny market. And so you're also going to have a lot of speculative interest in being in that.
Yeah. Well, I mean, I'm not sure if we talked about it before, but just talking about that I guess it wouldn't be geopolitical risk. We're in that market already, but the jurisdictional risk, I mean, is there now a premium going to U.S. producers?
There is, but I do think that the world is changing pretty rapidly. So the activities of the U.S. and Venezuela makes a big difference. Yeah. What's happened in Argentina makes a big difference. And I think what you'll see is those places, Bolivia, for example. So the company that I represent on this Silver Institute, Bolivia has gone from being uninvestable to being very investable. And Bolivia is the fourth largest silver producer in the world. That's a place where I think you could see significant growth. But it's not going to be for about another 5 years.
Yeah, it's not tomorrow.
Calling a $100 billion silver market large misses how small it really is in global capital terms. Phil Baker highlights that even optimistic recycling and capacity expansion add only 150 to 200 million ounces to a 1.2 billion ounce market, barely moving the needle. Jurisdictional risk premiums are shifting, but not always where headlines suggest, as countries like Bolivia quietly reopen to investment. That creates opportunity, but with long delays, investors rarely price correctly. The real risk is assuming political change equals immediate supply growth. What Phil Baker notes next reframes jurisdiction risk as timing risk, not headline risk.
What do you think is the most misunderstood thing looking at 2026?
I think there's too much worry about where the silver price is going to go, right? Look, at $100, the silver price is at a level where these companies are going to do quite well. They're going to generate revenue that will allow them to pay dividends. And so the investment thesis for these companies is going to change in a way that you haven't seen before. And I think there's too much chasing the new thing. It's and to a certain extent seeing these assets operate and produce, and then look for things that that the risk profile of putting things into production can be managed.
Yeah. As a producer, I mean, you running numbers at $100 silver. Are you looking at what is our new base on the all-in sustaining costs? I mean, these haven't even hit the revenue numbers yet on a lot of these companies.
Yeah, so it's certainly costs will go up. There's no doubt about that. But if you look at the average cost of the primary silver producers, somewhere below $20 is where it has been.
The fixation on short-term price swings distracts from what $100 silver actually does to business models. Phil Baker points out that at these levels, producers can fund dividends and reinvestment, fundamentally changing how investors should value them. With average all-in sustaining costs historically below $20, even rising expenses leave margins unusually wide. That gap gives companies breathing room most commodities never see. For long-term portfolios, this shifts focus from speculation to durability and cash flow resilience. What Phil Baker explains next addresses why political risk isn't the immediate threat many investors fear.
I think you'll see it increase, but you think about those margins, whether the price of silver is 100 or plus or minus that, those margins are going to be extraordinary.
Are you, we got to address the risks that come with success, obviously, when we look at some of these things. I mean, the commodity margins have exploded a little bit, but obviously government scrutiny usually follows. So I'm just wondering, if you were a CEO today, are you preparing for windfall taxes, or is it more royalty hikes?
I would suggest to you in this market, given the recognition of the importance of the minerals being produced, that's not the thing I would be concerned with now. Right. Years into the future, that's probably something to have some concern over, but not at the moment.
Okay, I like this because, I was talking to a couple of contrarians just before and they said, okay, I don't know how long this bubble has to run. I mean, is the base now, we don't need to, it's 103 and the spot market closes in, 7 hours. So who knows what it's going to be pushed back to or where it'll settle. But is $80 kind of the new base?
Extraordinary margins usually invite political interference, but timing matters more than fear. Phil Baker argues that today's recognition of silver as a strategic material delays the usual reflex toward windfall taxes and royalty grabs. That contradicts the common narrative that governments immediately punish success. For investors, this suggests current cash flows may remain intact longer than expected, supporting higher base valuations. The real danger lies later, once prices normalize in public perception and scrutiny returns. What Phil Baker hints at next reframes the bubble debate around where a sustainable price floor might actually form.
Yeah, it's hard to say where the base is, but it's certainly at a level that the companies will generate significant free cash flow for development, for paying dividends, for growth. So that's not something I would be too terribly concerned with.
We talked a little bit about that decoupling of silver. We always talk silver-gold ratio, what have you. The fact that these two metals have been going together, and every dip in gold comes with a dip in silver. We know how it works, but,
silver's been catching up.
It's been catching up. It almost feels like this year it's just getting started. The bubble narrative might be a little bit too quick.
Yeah, I think it's absolutely. Corrections are likely to happen. It never goes straight up, and it'll be interesting to see how big of a correction you have and get rid of really weak hands, people that are just simply momentum traders. But over the long term, it's going to continue to increase over time.
The real signal here isn't where silver bottoms next week, but how cash flows change when prices stay structurally elevated. As Phil Baker notes, free cash flow at these levels funds dividends and growth, even if volatility shakes out weak hands. The silver-gold ratio narrative is lagging reality, because silver has begun to close a multi-year performance gap after underperforming gold since 2020. Corrections are part of that process, but they often reset positioning rather than end trends. For investors, the risk is confusing healthy consolidation with a bubble peak. What Phil Baker says next reframes selling pressure as a function of time horizon, not fundamentals.
Now, I got to ask you, I know you can't obviously offer any investment advice, but you've been an investor in this space and talking to investors here on the ground, they've been holding onto these positions for 5-10 years, waiting for this market. Finally, it's coming alive. Are people selling too early? Would you recommend taking a bit of profit and just keeping in your cost?
Yeah, certainly that's what I've done. Yeah. But there's nothing wrong with taking some profits, but the fundamental basis, the rationale for why gold has increased, this whole debasement, all of the uncertainty that's happened, none of that is going away anytime soon. And as a result of that, gold, silver, all the things that are happening to grow the economy makes copper look very attractive. So none of that is changing. And it's not something where I think you need to sort of run from this sector.
Profit-taking feels uncomfortable only when investors forget why they owned the asset in the first place. Phil Baker makes a critical distinction between trimming exposure and abandoning a long-term thesis built on currency debasement and persistent uncertainty. Those drivers have defined markets since at least 2020 and remain unresolved going into 2026. Selling everything after a long wait risks missing the compounding phase that follows recognition. For balanced portfolios, discipline matters more than bravado.